Wander Wealthy Podcast, episode 78. Hello, everybody. Welcome back to the Wander Wealthy Podcast. My name is Tess Wicks. I'm your host, and today we have a solo show. Ladies, I have some great news for us, and it is that we are naturally very good at investing, and that is what we're going to be talking about today. I want to talk about why investing is so important, not only just for women, but all people, and why it's important to get started as soon as possible. And then I want to talk about why it's especially important for us women. Also, why women aren't investing right now, and maybe give you some tips and tricks on how to get over that hump, and then leave you with the reasons why when women do invest, how they're able to outperform our male counterparts when it comes to looking at the two portfolios side by side. What it is, naturally that we might hold, or just, how maybe we just might be a little bit smarter when it comes to investing. But really, it's just kind of intuitive nature. We just are naturally good investors. And I'm super excited about this because, when I think about investing, and I'm working on an investing course right now. So I've been outlining and slideshow making and statistics grabbing and doing all this work on putting together a really, really helpful walk through how investing works and how you can get a proper strategy together. And when I think about investing, I go back to when I started investing, or when I started even learning about investing. I was actually very young because when my brother was 12, I was 5 years old. And that is when he made his first investment in the stock market. He was like child genius. And I had heard this story from the age of 5 until, I was 12, and I was always curious about what this investing and buying stocks was. And I would ask my dad all the time and have him explain it, and I couldn't really grasp it. It's really hard to grasp investing as a whole. And it took a really long time, even throughout my college experience where I studied finance, I studied portfolio investing, I still didn't quite understand it. And so in this course, I'm really trying to break it down super specifically so that it makes sense and it's just intuitive and natural and all is good. You feel like you can watch me explain what a stock is and what a bond is and how it works to invest in the stock market or the bond market, and it's going to go, oh, that makes total sense now. So anyway, that is one of the reasons why I think people don't invest. In addition, a lot of people feel like they need to pick individual companies to invest in. Like you always hear, oh my God, Apple's such a hot stock. I bought it 12 years ago. I'm so glad I did. My money has quadrupled or 10 times multiplied. And yeah, that's like cool for them, but that's not a prudent investing strategy to pick individual stocks. Actually, most people lose when they do that. And that is one of the reasons why women tend to be better than men, because we don't have that ego tie to feel like we're picking the hot stock and then going to brag about it. We totally know that this is not our strong suit, and it's not men's strong suit either, by the way, but we recognize that and we're willing to go with a more passive strategy. So my point is, in getting into the first part of this podcast, is talking about why it's so important that everyone start investing, and the reason why a lot of people aren't in general, people in general as a whole, men and women, especially younger people, is because first of all, they just don't understand it. And second of all, they feel this pressure to find the right stocks to buy because that's what we've come to learn investing is. And really, that's not what investing is at all. But that's, of course, what all the pundits on TV want you to think investing is, because that's the only way they make investing actually interesting to watch on TV. Otherwise, the real strategy that wins is pretty boring. And that's kind of the honest truth, the honest takeaway when it comes to any discussion around investing is that your investment strategy, if you want a successful investment strategy, it should be boring and it should be nothing to brag about. You should just be like, oh yeah, I don't actually buy individual stocks. I buy all of them because I know that I can't predict what's going to happen in the future. That's why people don't get invested. They feel overwhelmed by the options. They don't know which ones to pick, and they just don't quite understand it. Or maybe one or the other, but generally that's what holds us back. But with that, I want to talk about why it's so important that everyone starts investing. So when you invest in anything. When you put forth money and buy a portion of something, whether that's a business, like you're being an angel investor and you invest in a business, or you invest in your own business, or you invest in the stock market and bond market, the financial markets, like we like to say, you're taking on risk. But with that risk, you're hopefully getting some sort of return. Now, that return comes in the form of this magical thing called compound interest. And we talked about this on the show before. In several interviews ago, I interviewed a woman named Amy, and I will make a note to add that to the show notes because she explains compound interest as multiplying baby rabbits. Like when one rabbit is born and then it has a couple rabbits and then those rabbits have more rabbits or bunnies and I don't know, rabbits, bunnies, whatever, but they just start multiplying and multiplying. That's kind of what compound interest is. You start with a certain dollar amount and then it makes some money, and then that money turning to the next year gets added to your base dollar amount. And so the money you made makes more money for you. Everything gets multiplied with compound interest. Now, I don't have a lot of time to further explain, but the idea is that with time and the magical power of compound interest, you can multiply your investments with a prudent strategy, not just picking Apple stock or whatever, picking individual stocks, but picking a prudent passive investing strategy, which I'm going to talk about at the end of this. By doing that, when you have time on your side and you have that compound interest that multiplies year over year, that's when investing really works. And it's usually in the last 15% of your timeline. So usually the last 5 or 10 years of your life when things really start to multiply and double. So the reason, again, boiling this back down to why people need to start investing and why they should, is because of that, the power of youth, their ability that they have time on their side. Someone 10 years older than you has a significant disadvantage compared to you because you have 10 more years to get started putting money in and then allow that money to multiply. There's those stories or those studies that are thrown around, and it's really basic mathematical analysis. I just used big words to sound smart, by the way. It's the story of Matt and Sam. And Matt decides to invest $5,000 per year for the first 10 years of his working career, from age 25 to 35. He invests $5,000 a year until 35, and then he stops. So he invests That's $50,000. And then Sam doesn't get started with investing because he doesn't recognize the value of time. And so he doesn't start investing until he's 35. But he invests the same amount, $5,000 per year, from age 35 to age 65 when he retires. So he's investing $5,000 over 30 years, not 10 years. So when Matt invests $50,000, Sam has invested, I hate it when I put myself on the spot like this. 5 times 30 is $150,000. And the funny thing is, after, the math wizards do all their math and work it all out, Matt, the person who only invested $50,000 but invested it for 10 years before, he actually ends up having more money because that $50,000 can multiply for the next 30 years of his life. He doesn't even have to add any more to it. While Sam is still investing, in total $150,000, and he doesn't have as much as Matt because he didn't start as soon. This is a common example that you'll see across personal finance blogs. I even have one on one of my blogs. And again, I'll link it in the show notes so that you can check it out. The point here is that's the power of youth. That's the power of time mixed with compound interest. Matt wins because he takes advantage of time and compound interest and he recognizes it. We understand that it's so important for us to start saving into an investment account because of this thing called time and compound interest. But why? Why can't you just save your money in a savings account? The reason is because it takes a lot of money to retire someday. And a lot of people are like, well, I'm never going to retire. I'm just going to work until I'm dead. Spoiler alert, newsflash, whatever you want to call it, sometimes you don't have a choice. Most of the time you don't have a choice. So much more often, especially these days, businesses and companies and government agencies are finding ways to be more efficient. And when they start to recognize that your skills are no longer as valuable as a ripe 25 or 30-year-old skills, they're going to find a way to get rid of you. And in potentially the nicest way possible, but they're going to figure it out. Now, maybe you want to be a business owner and you're like, well, I'll just run my business until I'm dead. Well, same thing, newsflash. You might get sick, you might get disabled, something or other will happen. Things are going to happen. Bad things are going to happen. That's, the cycle, the rhythm of life. As bad things happen, we pick ourselves up and we go on. But we need to recognize that bad things could potentially happen, and you might be forced to retire. You might be forced to go on disability. And the best thing that you can do for yourself in that case is to understand that you're going to need money at that time. You don't know when that time's going to happen, but you're going to need money. And that's why we need to consider putting money away today. Now, again, well, what about just putting it in a savings account? A savings account, especially these days, does not give you the return. It doesn't even give you enough return for your money to keep up with inflation, which means $5 today, which can buy a fancy latte from Starbucks, 20 years from now, won't even be able to buy a coffee from Starbucks. It seems like so unreal, but look at the price of movie tickets. Look at the price of gas. Look at the price of houses. I mean, it would be redonkulous for my grandma to look at house prices these days and buy her same house that she owns right now, because it would probably be worth 5 times what she bought it for back in, I don't know, the 70s or 80s. So this is really important. Things get more expensive, and when you put money into a savings account, that money doesn't keep up with the cost of things. So that's where investing comes in again. And if you follow a prudent investment strategy, you can hopefully return the historical average, which is, some people say 8%, some people go conservative and say 6%, some people say 10%. It depends what you are investing in. But if you do that, that's way better than the just under the average inflation rate, which is anywhere from 2 to 3% usually. And we're definitely getting under that, most of the people, when it comes to savings accounts. So that's why investing is also important, is because you need to be able to have some money that's going to grow so that you can access it later on in life, not just because you retire, but because maybe you're forced to retire because you're disabled, or you lose someone important to you and have to take care of someone else that was important to them. There's so many things that are unpredictable. And like I said, bad things are going to happen. Not to be a doomsdayer, but things happen and bad things will happen. And you'll really appreciate when your 20-something-year-old self or 30-something-year-old self said, you know what, I'm going to prepare for that. I'm going to start investing. That is the reason why everyone should start investing as soon as possible. But now I want to talk specifically why it's possible for women to start investing. So we all know about the gender wage gap. It's been extremely prominent in news and like equal rights pay days that you see, especially around social media. I'm always seeing information about the gender wage gap. We've been informed these days that women on average make 75 to 85 cents on the dollar compared to men. And I just say this kind of range because there's debates around, what kind of data we're looking at. But the story is that women make less compared to men. In the same jobs, it's their male counterparts. They make less. Now, in addition to there being this gender wage gap, and by the way, let's not be naive about it. This is women in general, but if you break it down into African American women, Asian women, Latino women, they're making even less than 75 cents on the dollar to their male counterparts. So it gets even worse. But there's also this thing called a gender wealth gap. Obviously, women make less money, so then they're not able to contribute as much to their wealth. But there's more reason than that why there is a gender wealth gap. So what is the gender wealth gap, first of all? Well, if we look at a single man and a single woman on average, but single, because once you get into combined finances, it gets a little bit blurry. So I just wanted to look at the single ones. And if you compare the two, the single man will have a net worth that is about 3 times larger than the single woman's. A woman might have $100,000, whereas a man has $300,000. And this is a problem, again, because first of all, women are actually more indebted than men are. And it's pretty obvious why. more women go to college than men, or the percentage of attendees in college, there's a higher percentage of women compared to men. And we all know college, especially in the United States, is expensive. And how do we pay for college like that? Well, a lot of people have to take out student loans. So women are taking on more student loan debt than their male counterparts. So that's one reason why that net worth is skewed, because women then have more pulling against their net worth than a man does. Now, add on top of it the fact that men in the same career get paid more than a woman does. So that tips the scales a bit. But in addition to that, women aren't as confident in investing than men are. Men are investing more and taking more chances and risks. Now, the women that do invest, the whole point of this podcast is to say, we tend to be better investors than men on average. If you look at a woman who is investing and look at her portfolio and compare it to the average male that's investing and look at his portfolio, women are actually doing better. But if you look at the whole of people investing and not, women are investing much less than men. And again, that's another reason why the scale is super skewed when it comes to the wealth between genders. This is also very important because for every dollar a man has in wealth, a woman has 32 cents on average. Again, this is all on average. And by the way, this is just going to be the disclaimer for the whole show. Everything is an average. You can't just pull one man and one woman and compare them apples to apples. But if you look at things as a whole, it paints a bigger picture. In addition to that, I also want to say that I'm about to make some probably big overarching generalizations about the different sexes and more so the nature and our kind of biological wiring. And that comes from a place of just tying a story to the statistics so we can better understand the why, because statistics really just tell us what, and I want to explain the why and the how. And it's easy to tie it to a story that has some of these generalizations that at least give us some idea. I'm not saying that every woman and man are like this by any means. I understand it is not like that. But when we're talking averages and we're looking back at history, this is kind of what pops up. So I just wanted to say that for a second. Okay, back to the gender wealth gap. Women have less wealth than men. Single women, at least. And it is also true for married women, but there's a lot of questions that get brought up about the then validity of that data set, so we're not going to get into that. But if we just look at the single ones, that tells us a big enough story. Women are less likely to invest, and that really stands out to me. Why aren't women investing? And the first thing that came up is that women lack the confidence to invest. I read a study done by Merrill Lynch, which is owned by Bank of America, and they had surveyed people and learned that only 52% of women said that they are confident about investing. And 41% of women reported that their biggest financial regret was not investing more. Now, the 52% of women who lack the confidence, this is compared to men who are more on the 40% scale or even less. That's one big discrepancy there. Women feel less confident about their ability to invest. By the way, in addition, what I pulled from this study was that 45% of women said they don't have a financial role model. So if you need one, hey girl, I'm here. Now, another reason why women may not be investing as much is because women are more risk averse, and sometimes this is to a fault. We know that investing in the financial markets is risky. There's a way that you can balance out that risk so that you're taking significantly less risk and still able to get those good returns instead of having to just put your money in cash or in a savings account. But women feel scared of the stock market because it holds risk. And this is where we get a little bit into the stereotypes, but women on average tend to be the nurturers, the caretakers, the ones who have more of a long-term vision for their family and making sure their kids are provided for, and so on and so forth. Again, broad generalization, but even as we look back in history, we know where our place had been. Our place has significantly changed since then, and I'm super proud of it. But in terms of risk and our wiring and the way that we perceive risk and understand it and are willing to take it, we're much less likely to do so. And that doesn't always serve us, especially when it comes to investing your money, taking on a bit of risk in the chance to make some money. The other reason why women are not investing is because women tend to allow someone else to control their finances, and specifically the more long-term stuff, which is funny because we're long-term focused, but when it comes to taking on risk and thinking about those more long-term things when it comes to the finances and investing specifically, we have let someone else take it on. And I don't know if this is just because of the male-female dynamic in heterosexual relationships, or if it's because of just the lack of confidence in our own ability to invest, but we've been at this point where, and it's been proven, women are more likely to manage the day-to-day finances of paying the bills and, doing the smaller day-to-day things. But when it comes to working with the financial planner and planning for investing and estate planning and so much more, it gets turned over to the male person in the relationship, and they then take the money and invest it. Or when working with a financial planner, and again, this is brought up a lot in the world of finance because there's so many more financial planners that are men than women, and not all of the financial planning men talk to the women as if she might be the breadwinner, or she might be the person that is in charge of the finances. The conversations are much more geared towards the men. Now, again, these are definitely stereotypes, they're generalizations, but they're generalizations that are based on fact. So I'm not saying every person is like this, but this tends to be the rhythm and the case in many situations. So women aren't being hands-on with their investments and long-term planning. They'll turn it over to someone else. And that's another reason why they aren't taking part in their investing, in their own investing for their future. I want you to remember this. Despite the fact that women earn less on average than their male counterparts, we tend to carry more debt, and we have a confidence problem when it comes to investing. But when we do invest our money, we are much more likely to do a better job than the average man. And that is really powerful. So why, and this is the good stuff here, why have we been able to outperform men when it comes to investing? The first reason that has come up in studies is that women save more, which is like, well, duh, we have to save more. We make significantly less money and we need to make sure that our asses are covered too. So of course we're going to be saving more. And yeah, that's probably the reason. We tend to save about 0.4% more than men on average. And 0.4% doesn't sound like a lot, but over the course of years, 0.4% could mean an extra $1 million. I mean, of course, depending on how much you're saving, but that could be a lot of money. Plus, with compound interest, you never know how far that could balloon. We are saving more. And the more you save into your investment accounts, the better it is for your investments. Your investments then have more ability to grow and multiply, not only from being able to give you returns, but also on top of that, you're able to get more out in dividends every single year. The next reason why women tend to be awesome investors, other than the fact that we're putting more money into our investment accounts, is that we take on less risk. So like I said earlier, some women will be risk averse to a fault, but the ones that are investing are risk averse, but they're risk averse, but still taking advantage of investing. And that's the sweet spot. Thanks to our obvious biological wiring, we kind of went through this world for many, many years as the nurturers, as the caregivers, as the ones that, stay at home and make sure that the babies turn into little kids that turn into adults. And I know that, again, this is like vast generalization. There are some women out there listening to this who still are the main caretakers and nurturers, and some of you might be like, that's not me. But regardless, this is in our biological wiring. When it comes to our personality traits, our personalities are much less likely to take on this big risk. Now, we're concerned with how things will play out in the long term because we want our kids, our children, or maybe our other loved ones, maybe it's parents or siblings. We want them to be cared for over the long term. So we're much more long-term oriented. And because of that, we make decisions based on knowing that we need to be a little bit more risk averse, meaning we need to make sure that our investments aren't put into risky assets. So when it comes to the investments that we are picking, we play this long-term long game strategy, which tends to be a more passive strategy. Men, on the other hand, especially if we go back to like genetical wiring, biological wiring, we go way back thousands of years, men were the ones that were the hunters and gatherers. They had to go out and they had to get the kill of the day and bring it home to feed their family. And so they are genetically wired to take on more risk. They're the ones that know, I have to go and I have to get the quick win and then bring it back. And although, I think both ways play very well, whether a woman is more risky or less risky, a man is more risky or less risky, it's good to have a good balance of both and understanding, like basically taking calculated risk. But if we just look at average people and look at these kind of generalizations from way back when humans evolved into this world, it's more natural for men to take on more risk. And that risk is not necessarily playing the long game like women do. It's playing the short game. It's getting that quick win. So when we bring this back to investing, the man is doing more of this active strategy. Now, again, not every man is playing this way, but they're more likely to play this way. They're more likely to get involved in active investing. And active investing is where you individually pick and choose the stocks that you want to be invested in and the bonds that you want to be invested in. Or you pay someone to do that for you because they're telling you how shiny and sexy it is and you're buying into that. Women have developed this understanding of playing the long game, playing the boring game, and understanding that the strategy of passive investing, where you just invest, you go, I don't want to pick and choose because I don't know which ones are going to be great. I'm just going to invest in all of it. So you invest in what we call index funds. That is playing this passive strategy. It's passive because you're not picking and choosing. You're just saying, I'll just be in it all. And little did we know until even the 90s, this was actually the better game to play. It's actually a much better game to play because on average, 90% of active traders, active investors, people who are picking and choosing their own individual stocks to be in their own investment fund, they do worse than the average index. They're performing worse than the market's average. And women are on the other side and investing kind of everything because they don't want to play that short, quick win game where then they go back to their buddies and brag about this new stock that they heard a hot tip about. So they're playing this long game where they're doing boring stuff and investing in all of it, and they're performing at the average, maybe even a little better because they're investing in the index. So the active investment managers and the active individual investors, 90% of the time do worse than the index, which tends to be the average, and women meet the index or do better because they're investing in the index. Say what? Now, again, it's not just women and it's not just men. There are a lot of men passive investors and there are a lot of women active investors. But like I said, men are more likely to engage in active investment management styles and women are more likely to engage in passive. And that's why they are able to outperform men. Pretty cool. So the other reason why women are able to outperform men, it kind of goes right along with that. Women in general are better at diversifying, meaning they're not just taking this passive approach and going, okay, I want to invest a little bit into everything. They also understand the value of diversifying between asset classes. They're not just investing in all stocks, they're investing in some stocks and a little bit of bonds, or maybe half and half, or maybe more bonds and less stocks if they're closer to retirement age. Whereas men might still be, excited about these quick wins and the short-term kind of view and being more risky, that they aren't understanding the value of offsetting the risk of a stock with the bonds. Now, again, some people are, but this is just what the data tells us. In addition to that, women are better at diversifying because they're willing to invest in those index funds. They're willing to invest in all of the different stocks that are in the market instead of picking and choosing. And why exactly would they be inclined to do this? It's not necessarily because they've researched the best investment strategy, although maybe they have. Women do tend to be more prone to doing their due diligence and making decisions. They're less impulsive. Women are more likely to do research in which they might be able to find this information. But in addition to that, if they're investing especially through their 401ks, 403bs, IRAs, they might be offered the opportunity to invest in something like a retirement date fund. And most retirement date funds will offer the opportunity to invest in index funds, meaning all of the stocks that are being measured by one of the big indices that tracks the US stock market. So a retirement date fund is generally a fund that is made up of a mixture of index funds that track the US and the international stock markets, as well as some index funds that track bonds, US bonds, total US bond market, or maybe international, but more likely the total US bond market. And basically, that retirement date fund just slowly goes from being more invested in stocks to less invested in stocks and more invested in bonds as the person gets closer to their retirement date. So when you look at your 401k or 403b or whatever it is, you might see options for a retirement date fund, or it can also be called a target date fund. And then you'll likely see a year. And it'll be like 2055, or you want to find the one that is closest to your personal retirement date. That basically would then mean they will consider how old you are today, because they know when you're going to retire, and consider how long you have until you are going to retire. And then they'll know kind of how much to put of the money you're contributing every month into stocks versus bonds. And because these are index funds, you don't have to pick and choose anything. It's also less costly, and it will rebalance in accordance to how you age through life. Whereas if you look at an active investor, they will rebalance your fund just kind of whenever they find a better stock that they think is going to do better, which generally is not. And it's not a prudent strategy at all. It's not very wise to go about doing active investing, because you're not taking that slow and steady route. You're making impulse decisions. You're just making decisions based on your emotion, based on seeing money going down or stocks going down or whatever it is. And it doesn't set you up for success. Whereas most often women choose kind of the boring route. They choose here, just do it for me, but they don't pay an active manager to manage it impulsively. The last reason why women tend to outperform men is because we trade less. And I'll be very clear on what trading means, but the statistics say men are 35% more likely to make trades in their portfolio than women are in theirs. Now, what is a trade? A trade is when you sell a stock and buy another stock, or you're just buying in general or selling in general, and you're moving things around in your portfolio. Now, because women are more likely to take this passive strategy, the boring strategy, as we said, you're also much less likely to trade, because if you're investing in the index does not change that much. And no one is actively picking and choosing stocks to add to it, because if let's say you're invested in a S&P 500 index fund, well, that tracks the 500 leading companies in the United States, generally the 500 largest companies in the United States. And that's not going to change just all the time. Maybe it changes every couple of years, but I don't even know. I don't know how often it changes, but it is not much. So we're not worrying about these companies leaving the fund and then having to buy a new company that's entering the fund very often. But if you look at a portfolio that is actively managed, that maybe a man is more likely to be invested in, whether it's his own active management or he pays someone, they are researching new companies all the time. Which ones are undervalued? Which ones are overpriced? Which ones can I get a good deal on? And they're trading in these portfolios. And the problem with that is that when you make these trades, when you're buying and selling these assets, that comes at a cost. It's not cheap. Someone's got to manage that stuff. Trading costs money. So you're going to have to pay a fee when you sell or when you buy most often. And the cool thing is, so when you're doing active investing, if you're paying someone, you're going to be paying them probably a pretty high fee, much higher than if you paid someone to do a passive investing portfolio for you. You could pay a manager, an investment manager, but one would be an active manager and one would be a passive, and passive is much less likely to charge you as much as an active manager. On top of that, when that active manager makes trades, you're going to be paying those fees as well. Whereas if the passive manager is managing this, index portfolio, there's hardly ever going to be trades. So you're not going to be paying these fees. So the active investor, the person who chooses to be more active in their investments, they're going to pay a lot more. And that eats into their returns, how well they do in the market. I say this, fees are the devil in the investment world. They really are. They are not good. And we need to find ways to stay away from them. And I know fees can be really confusing. I'm planning on making sure I cover this very clearly in my investment course on getting you very well aware of what fees to look out for, because they're hard to understand. But it is important. You need to know that fees are not good. They're not. If a man is more likely to do active investing, then he is more likely to pay these fees. He's more likely making more trades and all of the above. Even if a man is doing more passive investing, he may be more likely to make more trades. Well, he is more likely to make a trade, 35% more likely. Whereas women kind of have that set it and forget it, long-term strategy mentality. And again, just playing the boring long game. Nothing big to brag about. That's pretty much it. That's what I wanted to share with you guys today. I think it's so important to recognize that investing is super, super important for your future. And if you're not doing it now, it's time to get started. I know it's scary. I know it's intimidating. That's why I have a 10-day free investing 101 bootcamp. I send you 8 emails in 10 days and really explain this passive investing strategy that from the data, we're assuming women are more likely to take on. And that's also why they are more likely to outperform men. It's the idea of taking the lazy way out. Setting it, forgetting it, playing the long game, but knowing that if you are prudent, if you understand what's going on, you can actually be very successful when it comes to investing. So I invite you to join the Investing 101 Bootcamp. You can go to wanderwealthy.com/invest to get in. I'll send you 8 emails over the course of 10 days, explain everything. And if you want to take your investment knowledge to the next level, even if you're working with a financial advisor, but you just want to know, like have a clue about what's going on and feel confident that maybe if someday you had to, you could, then I definitely invite you to stick around because I'm currently working on the Invested course. It's called Zero to Invested, but for short, I just call it Invested. And it's really going to help you get invested within 30 days. And I'm super excited about it. It's one of my favorite things that I've ever created because I love this stuff. I love investing. I love talking about investing. I love helping people understand the power behind investing. And it really doesn't have to be scary. And I know how you feel because I've been there. But you really just got to jump in and then start understanding more and more how this world works. And you can grow some really significant wealth. You really can. Okay? So I'm going to leave you at that. Remember to grab the investment bootcamp at wanderwealthy.com/invest. I'll also include it in the show notes. And by the way, I know I mentioned a lot of kind of random things to point you to in the show notes. So if you want to find the show notes, go to wanderwealthypodcast.com/podcast/episode 78. The number is 78. All right. Thank you for hanging out with me today. And until next time, I hope you wander wealthy.